Right now, you are probably paying taxes. Every month, a chunk of the money you worked hard for gets taken out before you even see it. Income tax, sales tax, it comes from everywhere, and most of us just accept it because we were told this is simply how the system works. But here's something worth thinking about. Some of the richest people on earth, people worth tens and hundreds of billions of dollars, legally pay little to no income tax at all. Not because they are breaking the law, not because they are hiding money somewhere, but because the tax system was built in a way that works very differently for people at the very top. This is how that works. Before we get into this, it is important to be clear about one thing. This video is not about telling anyone to be angry at wealthy people. It is simply about understanding how the tax system actually works, because most people were never taught this in school. And when you understand it, you will see why two people can earn very different amounts of money and end up paying very different percentages in tax. One of them might be you, paying a big portion of every paycheck to the government. The other might be someone worth $50 billion, paying a smaller percentage than you are. This has been documented by journalists, economists, and government reports. It is not a conspiracy theory. It's just how the system works. And today, we're going to walk through exactly why. To understand why billionaires pay so little in taxes, you first need to understand how most ordinary people pay taxes. When you go to work and earn a salary, that money is called earned income. And earned income is taxed heavily. In most countries, the more you earn from a job, the higher the percentage you pay. Someone earning a regular salary can pay anywhere between 10 and 37% of their income in federal tax alone. On top of that, there are state taxes and other deductions. By the time everything is taken out, a working person loses a significant chunk of every paycheck before they ever get to spend it. This system makes sense on the surface. People earn money, the government takes a percentage. That money pays for roads, schools, and hospitals. This system was designed around one specific type of income, the kind that comes from working a regular job. And billionaires, for the most part, do not make their money by working a regular job. Billionaires do not get rich by collecting a salary. They get rich by owning things, stocks and companies, real estate, businesses, investments of all kinds. And here's the critical difference that most people never learn. When the value of those things goes up, that's not considered income under the tax law. It's called an unrealized gain, and unrealized gains are not taxed. Here's a simple example to make this clear. Imagine someone owns shares in a company worth $1 billion at the start of the year. By the end of the year, those shares are worth $2 billion. That person just gained $1 billion in a single year. But because they did not sell those shares, that gain is considered unrealized. And under current tax law, you only pay tax on an investment when you actually sell it and receive the cash. Until then, the gain exists on paper, but there's no tax bill. This is how someone can add billions to their net worth in a year and still report very little taxable income. Their wealth grows enormously, but their tax bill stays very small because wealth and income are treated as completely different things under the law. But it gets even more interesting because even when a billionaire needs actual cash to spend in their daily life, they have a clever way of getting it without selling their investments and triggering a tax bill. It's called borrowing against your assets, and it's one of the most powerful tools available to extremely wealthy people. Here's how it works in simple terms. A billionaire has shares worth $10 billion. They don't want to sell those shares because selling would mean paying capital gains tax. So instead, they go to a bank and use those shares as collateral to take out a loan. The bank sees $10 billion worth of assets and happily lends them hundreds of millions of dollars at a very low interest rate. The billionaire now has hundreds of millions of dollars in cash to spend on whatever they want, a house, a yacht, anything. And how much tax do they pay on that loan? Absolutely nothing, because a loan is not income. You're borrowing money, not earning it, and borrowed money is never taxed. When they eventually need to repay the loan, they can borrow again using their growing assets, or they can sell just enough shares to cover the repayment, often timing it carefully to minimize the tax. This strategy is so well known among tax experts that they even have a name. They call it buy, borrow, die. You buy assets, you borrow against them to fund your lifestyle, and And when you die, your heirs inherit everything at its current value, completely wiping out all the built-up gains and resetting the tax bill to zero. It's perfectly legal, it's widely used, and it means that for many billionaires, the total tax paid over an entire lifetime of accumulating wealth can be remarkably small. There's another layer to this that makes the whole picture even clearer. Most extremely wealthy people own or control large businesses, and owning a business opens up a whole world of legal deductions that ordinary employees simply don't have access to. A business can deduct its expenses from its income before calculating how much tax is owed, and what counts as a business expense can be surprisingly broad when you have good accountants and lawyers working for you. The private jet used to travel to business meetings is a business expense. The luxury car used for work purposes is a business expense. The home office is a business expense. Meals with business contacts are business expenses. In some cases, even the artwork on the walls of a corporate office can be written off. None of this is illegal. These deductions are written into the tax code, and any business owner can use them. But the scale at which they are available to someone who owns large businesses is simply not comparable to what an ordinary working person can claim. A regular employee cannot deduct their daily commute, but a billionaire can deduct their private jet flight if there is a business reason attached to it. On top of everything we've already covered, there's one more tool that very wealthy people commonly use: legal offshore structures and holding companies. Many wealthy individuals and large corporations establish legal entities in countries with very low or zero tax rates, places like the Cayman Islands, Luxembourg, or Singapore. In many cases, this is not illegal. It's simply using the rules of the international tax system to move money through structures that minimize what is owed to any government. A corporation might earn billions of profits from customers in high tax countries, but legally record those profits in a low tax country where they have set up a subsidiary. An individual might set up a trust or foundation in a place with favorable laws that allows wealth to pass down through generations with very little tax. These structures cost a lot of money to set up and maintain, which means they are only available to people who are already very wealthy. The complexity itself is a barrier that keeps these tools in the hands of those who can already afford the best legal and financial advice available. In 2021, a news organization called ProPublica obtained real tax data from some of America's wealthiest people and published a detailed report on what they actually paid in taxes compared to how much their wealth actually grew. What they found was remarkable. Over a 5-year period, the 25 richest Americans saw their combined wealth grow by more than $400 billion. Over that same period, they paid a combined total of around $13 billion in federal income taxes alone. When you calculate their true tax rate, measured against how much their wealth actually grew, it came out to around 3.4%. Meanwhile, a regular American worker earning a normal salary pays an effective tax rate many times higher than that as a percentage of what they actually take home. This is because these people did not do anything illegal. It's simply because the tax system measures income and not wealth growth. And for people whose wealth grows through appreciating assets rather than a regular paycheck, the gap between getting richer and owing taxes can be enormous. The obvious question at this point is, why does a tax system work this way at all? Why are the rules written in a way that so clearly benefits people who are already extremely wealthy? The answer is a mix of history, economics, and political influence. Some of the rules around investment taxation were originally designed to encourage people to invest their money in businesses and the economy, the idea being that heavy taxes on investment returns would discourage people from investing and slow down economic growth. Wealthy individuals and large corporations spend enormous amounts of money funding political campaigns and lobbying governments to keep favorable rules in place. They employ large teams of lawyers and accountants whose entire job is to find ways to use the tax code in their favor. And over many decades of this kind of influence, the tax system has gradually developed in ways that consistently benefit those with the resources to navigate it. The system didn't end up this way by accident. It's the result of decisions made over many years by people with the power to shape it, very often in their own interest. Some countries have started exploring wealth taxes, taxes applied not just to income, but overall net worth above a certain level. Others have discussed closing the loopholes that allow inherited wealth to avoid taxes entirely. Others have pushed for minimum tax rules that make sure very high earners pay at least some meaningful percentage no matter how their money is structured. Subscribe to Unfolded if this opened your eyes a little wider today. We will see you in the next one.